Hi guys, welcome to a simpler approach. If you are new to the channel, please subscribe, like, comment, and share. Right now, I'm a little happy. And when I say happy, I mean like this kind of happy. You know why? Because the device I was using to do this, obviously, is up and running once again. And I am so grateful. It broke my heart when I could not do this because I enjoy doing this. So, well, you can see me, I can see you, but you can see me. You feel me? Yeah. And I'm really grateful. I'm really appreciative of that. So, once again, I'll be able to do my regular intro, my regular outro, and where the delivery of the content is concerned, then we will do that in the regular forum. I am also grateful for all the positive feedback that I've been getting in terms of the content being simple, to the point, precise, and concise. And it means a lot to me because the mission that I set out on in the first place, to make principles of accounts easy to understand, that mission is being fulfilled. And I am truly happy and I'm truly grateful for that. Yes. Okay. So today we'll be looking at double entry. Now, I must tell you two things. One, double entry is a very serious topic in principles of accounts. It's one of those foundational topics that intertwines with a lot of other topics to come. And so I ask, please, when you are doing double entry, as you're about to start, please pay keen attention as we progress. Okay? Secondly, double entry has four compartments: assets, liabilities, and capital, the asset of stock, revenues and expenses, and balancing off double entry accounts. For the next few weeks, we will be taking on those sections one by one. And right now, we will be starting with double entry for assets, liabilities, and capital. Let's go! Our objectives for this lesson includes knowing what are assets, liabilities, and capital, and understanding the basic concept of double entry as it relates to assets, liabilities, and capital. Before we go any further, before we attempt to understand, even in the slightest way, what double entry is, there are some key terms that we must know. Okay? Number one, assets. What are assets? Assets are items of property that are owned by a business entity. Now, there are two classifications of assets. You have fixed and you have current. Fixed assets are assets that are bought for long-term use. They aren't bought necessarily for resale. Okay? They are bought to be used for a long time. So you talk about land, motor vehicles, buildings, chief examples of those. Okay? Current assets are assets that are easily converted to cash. It is easy to convert them to cash. So we're talking about stock, we're talking about debtors, our bank balance. Okay? Those are key or widely used as examples for current assets. Okay? Now our liabilities, which is number two, our liabilities are obligations that we have to individuals or other businesses. And those obligations primarily comes from the process of owing. So items were bought on credit and have not yet been paid for. So we call those liabilities. Those are obligations. Okay. Number 3, capital. Capital refers to the resources that are used to start or to maintain a business entity. Now, capital primarily comes from the owner of the entity, okay? And there is this understanding that capital is used to start a business. That is not entirely true, because capital can be injected into a business entity by its owner at any point in time. At the beginning, at the middle, close to the unforeseeable end, at any point in time. Okay? Cool. Number 4, double entry. Now, by way of definition, double entry is the process of recording a transaction twice. Once on the debit side of an account and once on the credit side of a corresponding account. We will dig deep into that in a few minutes. Okay? T account. T account is the place where all information relating to an asset, liability, and capital is placed. You will see an example of that in short order, but it's called T account literally because it shapes like a capital T. Yeah. The double entry rule. Let me clear my voice for this one. And let me come a little closer. If you do not understand anything else about double entry, understand the rule. The double entry rule is like the road code. It tells you on which side of the road you should drive. It tells you do not go through a stoplight. It tells you don't drive on the soft shoulder of the road. You catch my drift? So, the double entry rule is very critical to understanding the process itself. Okay? Now, the double entry rule literally tells when to debit, when to credit. When to debit what, when to credit what. Okay? Now, we have assets, liability, and capital. When an asset increases, you debit. When an asset decreases, you credit. When liability increases, you credit. When liability decreases, you debit. When capital increases, you credit. And when capital decreases, you debit. Now, I'm hoping this is not so, but I think you're probably wondering where this debit and this credit thing comes from. What is Mr. Martin talking about? I am kind of lost. Okay. If it is that you are lost, let us put all that we've been talking about just now into one big whole so that you can see clearly how all of this come into equation, how it comes together. Yes, how it all comes together. Okay? Example number 1. The double entry process can be summarized into 3 simple steps. Step 1 is to identify the items affected. Now, the example says, in 2010, May 1st, we started business with $12,000 cash. Now, the reason why it is necessary to have a firm understanding of what are assets, liability, and capital is so that you are able to, how should I put this now? Pick them out, for an easier way of saying it. You'll be able to pick out assets, liabilities, and capital out of a question so you will know how to manipulate the question. Okay? So the transaction says started business. Stick a pin right there. Asset, liability, capital. Which of the 3 you know have something to do with starting business? Capital, right? Cool. What did we start the business with? $12,000 cash. Cool. Cash is what? Cash is an asset. Okay? Now, right then and there, you would have broken down the transaction and you would have itemized what are the two items affected. And that's what step 1 says we should do. Identify the two items affected. Now, once again, in order to identify the two items affected, you must use the definition of asset, liability, capital so that you are able to pick out what is the item that is affected. Now, the transaction says started business, and we know that capital are the resources used to start or to maintain a business. So straight away, we know that one of the items affected is capital. Okay? The rest of the transaction says with $12,000 cash. Now we know that cash is an asset, a current asset to be exact. But the fact that it's a current asset doesn't matter. We simply need to identify it as an asset. Okay? Now, we're cool with step 1. Identify the two items affected. That would be capital and cash. Cool? Cool. Step 2. Determine if the items increase or decrease. Let me make this simple. The business just started. Therefore, there was nothing before. Which also means that both capital and cash have increased. Capital from 0 to 12,000, cash from 0 to 12,000. Okay? So both items have increased. Cool. Step 3. We are now back at this thing, the double entry rule. And we're back at the double entry rule because the double entry rule tells us when to debit and when to credit. Now, by way of definition, double entry say that you must debit something and credit something. That's how it works. And that is how we get recording a transaction twice, because you have to debit something and credit something. Therefore, the rule simply tells us when to debit, when to credit. Okay? Now, recall the two items that were affected, capital and cash. Now, apply the rule. What happened to capital? Capital increased. Did it not? Yes, it did. Now, according to the rule, look at it. According to the rule, when capital increase, to record an increase in capital, what do? You credit. Cool. Look at it again. To record an increase in assets, because cash is an asset and it increased. So, to record an increase in asset, what do? Look at it, see there. You debit. Cool? All right. For those who didn't see it at first. See, the circles, I'm kind of helping. Okay, you get the point. This is a T account. Remember I told you that we'll come to T account in short order. This is a T account. Now, everything relating to an asset, liability, or capital is placed in this T account. Over there is called the debit side. When we say debit an account, we simply mean that you must write the information on the left side using the particulars that you see. The date, the details, and the amount. Okay? The credit side is the right side. When we say credit an account, we mean that you must write the information on the right side, which is the credit side. Let's go again. That T thing that you see there is called a T account. And it is called a T account simply because it literally shapes like a capital T. The left side is called the debit side. When we say you debit an account, we mean you put the information on the left-hand side using the particulars that you see there. Okay? And likewise, for credit side, the credit side is the right side. Okay? And when we say you credit an account, we mean that you write the information on the right side. Are you with me so far? Hopefully you are. Okay, good. Okay, recall step 1, where we identified the two items that were affected, capital and cash. And also recall that we had already decided, according to the double entry rule, that we credit capital and debit cash. Now, whenever you perform, scratch that, whenever you are in the process of recording double entry, 2 T accounts will always be affected. Sometimes 3, but in this beginner stage, 2 accounts will be affected, which means that you are writing information in 2 T accounts. Okay? Now, the easiest way to explain this is to use capital account and then show you the cash account so you see clearly. Look at the capital account before us. When we were doing the T account just now, we learned that the credit side was the right side of the account. And when we are crediting an account, that's where we write the information. Now, capital increased by 12,000. And when capital increase, you credit. Now look at the capital account and tell me, well, you're going to say it, but I'm not going to hear. Tell yourself, on which side of the T account is the information recorded? You guessed it right. On the credit side. Okay? And that's what we mean when we say credit an account. Notice what is written there. The date, 2010, May 1. What's the detail? The detail is cash. Now, that is necessary because whenever you look at an account, the account itself should explain to you what has taken place. So when you're looking at the capital account, it tells you that there was cash on the 1st of May 2010 in the amount of 12,000. And by definition, we know what capital is. So capital, placed in the capital account of 12,000. Also, you should be able to look at the capital account and distinguish in what form was the capital in. Okay? And the account itself tells you that it was in the form of cash. Cool? Now, that's what the cash account would look like. We did say that that cash had increased from 0 to 12,000. Cash is an asset. When an asset increases, you debit. And we said when you debit, you simply write the information or you enter the information on the left side. Let's do this again. Look in the T account and tell me on which side is the information written. Very good. On the left side. Why? Because the left side is the debit side. And once again, notice what you see written for the detail. Capital. Why? Because once again, you should be able to look at a T account and understand what is happening. So when I look at the cash account tells me that on May 1st, I had capital of $12,000. That's it. I'm not going to leave you hanging like that. We're going to do some more examples so we can rivet. That's an accurate word. So we can rivet the information and so you can understand it a little clearer. Our second example. Bought a motor van by check, $8,000. Now, number one, anytime you see check, it refers to bank. Do not open any T account named check. No go so. Oh, for my international students, you should not open an account by the name of check. Whenever you see check, it means bank. Why? Because logically speaking, whenever you get a check, that's where you go to encash it, whether you lodge it to an ATM or you go into the teller to have it encashed. Yeah, naturally. So whenever you see check, bank. Cool. That disclaimer out of the way. So once again, bought a motor van by check. So we already know one of the items affected, bank, because that's how we paid for it. Now, what did we buy? We bought a motor van. That's the second item affected. So, bought a motor van. Motor van is the first one. How did we buy the motor van? By check. That's the second item affected. Okay? Now, let's break this down a little further. Motor van is what? An asset. A fixed asset to be precise. But it's an asset. Okay? Bank. Bank is what? Bank is also an asset. A current asset to be exact. But an asset nonetheless. Cool? So we have two assets being affected here. Okay? But as we will see in step 2, we will see that one increased and one decreased. Now, naturally, the bank account is going to decrease. Why? Because you are spending money. You are paying for something that you bought. So naturally, your bank account will go down. Okay? And you have bought a motor van. Assuming that there was none before, you have acquired a motor van. So your motor van has increased. Okay? So motor van increase, bank decrease. So we've taken care of steps 1 and 2. Step 3 is where we now apply the double entry rule. Okay? And let me stick a pin right here. Remember, whenever you get a transaction to perform the process of double entry, always use the 3 steps. It makes it easier to follow, easier to see, and easier to understand. And in most, if not all cases, you don't miss anything because the 3 steps would have taken care of everything. Okay? So, back to step 3. Apply the double entry rule. We have already realized and agreed that 2 items affected were both assets. Okay? And we have also agreed that 1 increase and 1 decrease. Now, looking at the double entry rule, when an asset increases, what do? We debit. Which of the items affected had increased? Motor van. Cool? So, therefore, we must debit the motor van account. Cool. Bank. What did we say happened to bank? Bank decreased. When an asset decreases, what do? You credit. Easy, isn't it? Yeah, it is. After you have done all 3 steps, then you open your T account. Okay? And for those who didn't see, debit right there for motor van, credit right there for bank. Awesome sauce. That will be your motor van account. Clean, simple. And remember, motor van had increased. When an asset increases, you debit. And debit means you write the information on the left side. Boing. There we go. And notice the detail. Bank. Why? Simple. Because when you look at a T account, the T account should explain to you what took place. So in my motor van account, I can see clearly that I bought the motor van by check, bank, and I paid $8,000 for it. Okay? My second T account in this case would be bank. Bank what? Bank decreased. When an asset decreases, what do? You credit. And by credit, we mean that you write the information on the left side. Cool? Pop. There we go. Once again, look at the detail. Why? Because the T account should explain what took place. Okay? That's why data and everything is there. So when I look at my bank account, it tells me that on the 4th of May, I bought a motor van for $8,000. It's getting a little easier to see, don't it? Yeah, told ya. One more example and then we'll be out of here. So, our third example, we bought fixtures and fittings on credit from FDR Limited. Fixtures and fittings, or in some books or even on the web, you might see furniture and fixtures. This is a concept or the terminology that refers to large movable items that are used to furnish an office or building space. So we're talking about bookshelves, light fixtures, ceiling fixtures, tables, desks, chairs. All these things come under one umbrella. Fixtures and fittings, or you may see it as furniture and fixtures. Okay? Now, this is an asset. Fixed asset to be exact, but fixtures and fittings is an asset. Okay, that's the first item affected, and it said we bought it. Cool. Now, how did we pay for it? Now, you see those two little words in the middle that says on credit? On credit means that you owe for it. Now, who do I owe for these items? FDR Limited. Now, think back. When we're dealing with assets, liability, and capital, one of those three things spoke to having an obligation, don't it? Owing somebody for something, don't it? Yes, liability. Now, this is the thing with liability. You cannot open an account named liability account. It doesn't work like that. Everything in accounts must be specific. Now, who did I trust or credit the items from? FDR Limited. That would be our second item affected. First, fixtures and fittings. That's what we bought. Second, FDR Limited. Why FDR Limited? Because we owe them. Because the items were bought on credit. So those would be the two items affected. Give me 1 second. That's more like it. Cool? So that takes care of number one. Identify the two items affected. Cool? Determine if they increase or decrease. Now, thinking about the liability would mean that we did not have any liability before. So our obligation bar, permit me to use that for now, our obligation bar has increased. We bought something on credit and we now owe somebody. Okay, so our liability has increased. Fixtures and fittings also increased by nature of buying it. When you buy something, the quantity of what you had before is now, they come together. It increased. So fixtures and fittings have increased, and FDR Limited, by way of our obligation to them, has also increased. Okay, that takes care of step 2. Step 3, apply the double entry rule. You're never gonna get rid of this, okay? The double entry rule, once you're doing double entry, you will never get rid of it. Okay, so this is one of the things that you must rivet to memory. Always remember the double entry rule. Okay, now recall 2 items affected: fixtures and fittings and FDR Limited. Now fixtures and fittings was what? An asset. When an asset increases, what do? You debit. You catch in the hang of it, right? Good. FDR Limited is what? A liability. When liability increases, what do? You credit. Cool? Now, remember now that debit means you record the information on the left side of the account, and credit means you record the information on the right side of the account. Okay? So, let's get to recording. Oh, yes. And for those who didn't see what's happening, yes, those 2 things Awesome. So, fixtures and fittings. Look where the information is recorded. It's recorded on the left side. Why? Because the left side is the debit side. And we did say when we were applying the rule that when an asset increases, you debit. Once again, notice what the detail is. FDR limited. Why? Because when you look at the T account, it should speak to you. So the fixtures and fittings account tells me that on May 12, I bought on credit fixtures and fittings from FDR Limited. Just by nature of the fact that FDR Limited is there means it's a liability. Because if you had paid for it, then cash or bank would have been there. Okay? And when you pay for the item, there's no need to open an account for who you bought it from because you paid for it. But when you bought it on credit, then you have to open an account with the person or business's name to show liability. Okay? And that takes us to FDR Limited's account. Right? And once again, the information is on the credit side. Why? Because when liabilities increase, you credit. And one more time, when you look at the T account, it should speak to you. So looking at FDR Limited, it tells me that fixtures and fittings was bought on credit from them. Okay? So that takes us to the end of our introduction to the concept of double entry. To summarize, remember, 1, you must know what are assets, liability, and capital, and know it to the extent where you are able to read a transaction and just pick it up. Oh, that's an asset. Oh, that's liability. That's capital. All right? Know it to that extent. 2, understand the double entry rule. When to debit, when to credit. Very critical, because even if you are able to pick out what are assets, liabilities, and capital, when you get to the point of putting the information in the T account, if you don't remember when to debit or when to credit, that will be an issue. And you end up debiting the wrong thing and crediting the wrong thing. And that will create a whole new different problem. Okay? That's 2. And 3, when you're opening your T accounts, ensure that your T accounts are accurate and they are precise. And to add to that, ensure that you practice, because the process of practicing will ensure that you get the hang of it. You get the hang of debiting what needs to be debited and crediting what needs to be credited. Okay? If you enjoyed that video, please subscribe, like, comment, and share. And as usual, if you have any questions, it doesn't matter what the question is. It could be on double entry, it could be on something else, doesn't matter. Leave that question in the comments section below and I will respond to you directly. Okay? Oh, and remember, I cannot say this enough. Principles of accounts is a practical subject. You gotta practice. If you don't practice, you're gonna lose your mojo. Okay? Awesome. Until next time, walk good, stay safe.